Our investment process is built around working out what we think a company's worth in 3 years or more, so we're always looking ahead to form a view on what we think the future holds for any given company. And while we're aware of what's happening to a company in the short run, we also have that longer term focus that gives us the ability to look through the noise. And with smaller companies typically being more volatile than the broader market, that can also mean greater opportunities to invest in companies that may have seen a short-term issue impact their share price, but for us may actually present a really attractive longer-term opportunity.
We are very active investors. We run concentrated portfolios as we want our investors to benefit from the in-depth fundamental research we conduct by only investing in our best ideas. However, our high conviction approach is only possible because of the strong risk management culture and processes at Lennox. All risks in the portfolio are understood and deliberate. Our portfolio has defined risk parameters within which we aim to maximize returns for our clients.
Smaller companies typically have less of a track record than many large caps, but that also presents the opportunity if you're prepared to do the work. And that's definitely a big part of how we invest at Lennox. We spend a lot of time out of the office, meeting with businesses and management teams. Typically we do over 500 of those meetings each year. And that's because in this part of the market, you absolutely have to get out and do the work. You can't just open the last 30 annual reports and understand the history of a business and the people involved. You actually need to get out on the ground and meet with them. And on behalf of our investors, that is absolutely what we do.
We look for undervalued companies using our long-term earnings forecasts. However, to be able to confidently forecast a company's long-term earnings, that company must have a strong management team, be well governed, and have a clear competitive advantage or moat to protect its earnings. This is why we don't invest in mining, energy, and other companies that have no product differentiation. These companies are price takers and heavily influenced by cyclical forces. Conversely, our process aims to identify growing, sustainable companies who are the beneficiaries of change. These companies are the leaders of tomorrow.
ESG is incorporated into our process by ingraining it into both our initial screening of what we consider for an investment, and several industries are automatically screened out purely on that basis, but then also through our own deep dive research into a company's ESG credentials. So if a company fails on either of those levels, we consider them a sub-investment grade business and won't invest in them. And assessing a business on their approach to ESG is something that we've always had as part of our investment process because we believe that it's important in terms of any business's future, but also because we believe that key areas within ESG are a good indication of the broader quality of a business.
We take a pragmatic approach to ESG integration. We believe not investing in companies with poor governance and business models with negative social and environmental consequences improves our ability to generate long-term return for clients. Companies with negative social or environmental consequences are not sustainable over the long term. Regulatory change or consumer behaviour will eliminate these business models over time. As minority investors, it is very important that we have alignment with management and key insiders. This ensures that they act in our clients' best interests. Regular, productive engagement with board members and management teams is an important driver of our investment returns.